Good afternoon, class. My name is Alec Jackson.
I'm Joe Costa.
And I'm Bryce Beatty, and we're here to present Verizon vs. AT&T. So to start off, I'm Bryce Beatty, and I'll be presenting Verizon's background information. Originally, Verizon was owned by AT&T, however, they were later mandated to break up in 1984. Verizon merged with GTE Corp. In 2000, which allowed for them to reach anyone around the world that needs to communicate with each other without a landline. Verizon currently employs over 144,500 workers across 150 locations, which includes their workers, their technicians, and engineers. A statement from the CEO of Verizon, whose name is Hans Vestberg, states that their business strategy continues to become more focused on building a sustainable and reliable network that populations around the world are able to use when disaster strikes. Next, I will be discussing AT&T's background information. Originally, they were founded in 1877 by Gardner Green Hubbard, who we know as the father-in-law to Alexander Graham Bell, which was the first person to invent the practical telephone. AT&T is one of the world's largest telecommunication companies in the world, and they supply their customers with cellular data and television services all across the globe. AT&T is located across the United States and abroad with over 246,000 employees to ensure the best quality of services. The CEO for AT&T is Randall L. Stevenson, and AT&T's business strategy is to compete in telecommunication markets to create reliable and connectable systems that everyone can easily use and access. Now, we will discuss the profitability, the liquidity, and solvency of each company. To begin, our focus company of Verizon had an earnings per share ratio of 3.76 in the fiscal year of December 31st, 2018, while in the current fiscal year of 2019, Verizon increased their earnings per share to $4.66. This shows that there was an increase in assets while keeping the liabilities lower and they chose to keep the preferred dividends the same. Within the fiscal year of 2018, Verizon had a profit margin of 12.3%, whereas in the fiscal year of 2019, our current period, they recorded a 3% increase in profit margins of 15%. In the fiscal year of 2018, Verizon had a return on stockholders' equity of 6.14%, while the current fiscal year, they increased to 7.11%. This shows Verizon is increasing its returns to shareholders and decreasing the amount of shares outstanding.
Thank you for your explanation, Bryce. Hey guys, I'm Joe Acosta, and I will be explaining our analysis on Verizon's liquidity and solvency, while also touching upon AT&T's profitability and liquidity. So in our analysis of Verizon's liquidity, we found that Verizon had a current ratio of 0.91 in the fiscal year of 2018, where in 2019, Verizon's current ratio had decreased to 0.84. This meant that Verizon had more liquid assets to cover its short-term liabilities in 2018 rather than in 2019. Next, we analyzed Verizon's inventory turnover, which we found that Verizon had a higher inventory turnover in 2018, coming in at 61.3, where in 2019 the inventory decreased to 51.7. This meant that in 2018 Verizon was able to sell and replenish its inventory faster than in 2019. Finally, we looked into Verizon's days in inventory, and we found that Verizon from 2018 to 2019 had increased its days in inventory from 6 days to 7 days. Now I'll be moving on to Verizon's solvency. In 2018, Verizon had a debt-to-asset ratio of 38%, where in 2019, it had decreased to 30%. This is important because this shows that Verizon was able to increase its assets enough to take care of outstanding short-term debts. Now we'll look at Verizon's free cash flow. In the fiscal year of 2018, Verizon had a free cash flow of $17,681,000. While in 2019, they had increased their free cash flow to $17,807,000. This is important for investors to see because this shows that Verizon had earned more money in their operating activities, as well as still paying their dividends to stockholders on time. Finally, we looked at Verizon's time interest earned. In the fiscal year of 2018, Verizon had a time interest earned of 2.81, where in 2019, it had increased to 3.8. This increase in time interest earned is important because this shows that Verizon had increased its ability to pay off its interest obligations on time. Next, we will be looking into AT&T's profitability. In the fiscal year of 2019, AT&T had an earnings per share of $2.04. This is important because this shows that AT&T had a $2.04 incentive for investing. Next, we'll look at AT&T's profit margin. In the fiscal year of 2019, AT&T had a profit margin of 8.26%. This shows that AT&T had an average of 8% above market average on their rate of return of sales. And finally, we'll be looking into AT&T's return on common stockholders' equity. In the fiscal year of 2019, AT&T had a return on common stockholders' equity of 7.59%. This meant that AT&T is a low-risk, low-reward stock investment, but is still showing that they can make returns to its shareholders. Now we will be looking into AT&T's liquidity. In the fiscal year of 2019, AT&T had a current ratio of 0.8. This meant that in the fiscal year of 2019, AT&T had a greater number of short-term liabilities compared to its current assets. Next, we looked at AT&T's inventory turnover rate. In the fiscal year of 2019, AT&T had an inventory turnover rate of 29.85. This turnover rate meant that AT&T had minimal funds tied up in its inventory, showing to investors that the company is efficient in taking its resources and turning them into sales. Finally, we looked at AT&T's days in inventory. And in the fiscal year of 2019, AT&T had a 12.16 or 12 days in inventory. The 12.16 represents how long a product stays in inventory before the product goes out and is set for sale.
Thank you, Joe, for that explanation. I'm Alec Jackson, and I'll be going over AT&T solvency, comparing Verizon and AT&T's ratios, giving you a glimpse of what to expect for Verizon's and AT&T's future, and what we found through all the data. AT&T solvency shows that AT&T had a debt-to-asset ratio of 63.40%, which means that AT&T had a significant portion of assets to cover their outstanding short-term debt. In the year of 2019, AT&T had a times interest earned of 3.19, which means they could pay interest expense 3.19 times over. In the year of 2019, AT&T had a free cash flow of $14,005,000. For this, we see that AT&T has a $14,005,000 of free cash flow, which will be used to invest in the company or pay dividends. Comparing Verizon and AT&T's ratios. For Verizon's current physical ratios, profitability EPS is at $4.66. For liquidity, current ratio 48.1, inventory turnover 51.7, days of inventory 7.02 or just 7 days. Solvency, debt to asset is 38%. Free cash flow $17,807,000. For AT&T's current physical ratios, profitability is EPS at $2.04. Liquidity, current ratio is 8.1. Inventory turnover 29.85. Days of inventory 12.16 or 12 days. Solvency, debt to asset 30%. Free cash flow $14,005,000. As you can see, Verizon pretty much, without comparison, beats AT&T in each ratio except for debt to asset. And for investors, this would prove that Verizon would be the better bet. What to see in the future from Verizon and AT&T. For Verizon, you would see steady growth due to an increase in profit margin. An increase in EPS shows that Verizon's increases in assets while keeping preferred dividends the same. High debt-to-asset ratio shows that a significant portion of its assets are funded with debt so they can take on more risk. For AT&T's future, investors will see slow but steady growth due to an above-market profit margin. Slow but increasing EPS shows that AT&T is increasing its assets but also increasing its preferred dividends. Lower to debt to asset ratio shows that AT&T has less assets that are funded with debt so that the company is taking on less risk. Through our analysis, through profitability, liquidity, and solvency, we concluded that Verizon is the better company to invest through all the empirical data.